Are you afraid of investing in stocks? Do you think it's too complicated, too risky, or that you need a lot of money to get started? I get it. Most people feel the same way. But the truth is, investing in stocks could be the key to transforming your financial life and achieving the freedom you've always dreamed of. Today, I'm going to show you how to start in a simple, safe way, even with a small budget, so you can take the first step toward a prosperous future. Curious? Stick with me until the end. This might just be the decision that changes your life. 1. Understand what stocks are. Stocks, also known as equities, represent fractional ownership in a company. When you purchase a stock, you effectively become a part owner of that business, holding a stake in its successes and failures. This ownership entitles you to certain rights and benefits, depending on the type of stock you own, as well as potential financial gains or losses. There are primarily two types of stocks: common shares and preferred shares. Common shares, also known as ON shares, give you the right to vote in the company's decisions, such as the election of its board of directors or other strategic matters presented at shareholder meetings. These shares are often preferred by investors who want to have a say in the company's direction and potentially benefit from long-term price appreciation. Preferred shares, on the other hand, do not usually come with voting rights. However, they offer priority in receiving dividends, portions of the company's profits distributed to shareholders, and are generally considered more stable in terms of payout. The profits you can make from stocks come in two main forms. The first is through price appreciation, which occurs when the stock's market value rises. For example, if you buy a stock for $10 and later sell it for $15, you make a $5 profit per share. This type of profit depends on the company's growth and overall market conditions. The second form is through dividends, where the company shares a portion of its earnings with shareholders. Companies that consistently generate profits and have a solid financial foundation often pay dividends, which can provide regular income to investors. However, stocks come with inherent risks. Unlike fixed income investments, their prices can be highly volatile, fluctuating due to various factors like the company's performance, economic conditions, industry trends, or global events. It's possible to lose part or all of your investment if the company underperforms or its stock price plummets. Despite these risks, stocks are a fundamental asset for building wealth over the long term, especially if you invest in stable, growing companies. 2. Define your financial goals. Before diving into the stock market, it's critical to have a clear understanding of why you're investing. Ask yourself, what do you want to achieve? Your goals might include financial independence, securing your retirement, buying a house, funding education, or traveling the world. Defining these goals will not only help shape your strategy, but will also guide your decisions in selecting appropriate stocks or investment vehicles. Your financial goals should be categorized based on the time horizon: short-term, medium-term, or long-term. Short-term goals typically span 1 to 3 years and might involve saving for a down payment on a home or an emergency fund. In this case, it's better to focus on conservative investments, such as real estate funds or ETFs, which are funds that track stock indices and provide diversification without requiring deep expertise. Medium-term goals, which range from 3 to 5 years, might include saving for a child's education or starting a business. At this stage, you can begin exploring individual stocks, particularly those with strong growth potential. These stocks may carry more risk, but they can yield significant returns over this time frame if chosen carefully. Long-term goals, which extend beyond 5 years, are ideal for stock market investments. Stocks tend to outperform most other asset classes over the long run, despite short-term volatility. If your objective is retirement or financial freedom, investing in well-established companies or growth sectors can provide the potential for substantial appreciation over time. The long-term approach allows you to ride out market fluctuations, benefiting from compound growth and consistent contributions to your portfolio. Having clearly defined financial goals not only motivates you to stay disciplined, but also helps you measure your progress and make informed adjustments to your strategy along the way. 3. Build an emergency fund. Before venturing into investments, building an emergency fund is a fundamental step in securing your financial stability. An emergency fund serves as a financial safety net designed to cover unforeseen expenses such as medical emergencies, car repairs, or even periods of unemployment. This fund ensures you have access to liquid resources without the need to sell your investments during unfavorable market conditions, which could result in significant losses. The amount you need in your emergency fund depends on your monthly expenses and lifestyle. Financial experts typically recommend setting aside the equivalent of 3 to 6 months' worth of living expenses. For instance, if your monthly expenses total $2,000, your emergency fund should range between $6,000 and $12,000. This amount will provide you with enough cushion to handle emergencies without disrupting your financial plans. To maintain its purpose, your emergency fund should be invested in secure, low-risk financial instruments that allow quick access to cash. Options such as Treasury Select Bonds, CDBs with daily liquidity, or money market funds are excellent choices. These instruments offer stability, ease of withdrawal, and low risk, ensuring that your emergency fund remains reliable during crises. Having this fund in place allows you to approach investing with confidence, knowing that your essential expenses are covered no matter what happens. 4. Choose a brokerage firm. Choosing the right brokerage firm is a critical step in your journey as an investor. A brokerage acts as an intermediary between you and the stock market, providing the tools and platforms necessary for buying and selling securities. This institution simplifies the process of investing by offering digital interfaces such as mobile apps and online platforms that allow you to access the financial markets with just a few clicks. When selecting a brokerage, there are several factors to consider to ensure it meets your needs and enhances your investment experience. First, take a close look at the brokerage fees. Some firms charge fees per transaction, while others offer commission-free stock purchases. Understanding these costs is important because they can impact your profitability, especially if you plan to trade frequently. The usability of the brokerage platform is another important consideration. An intuitive and user-friendly interface is crucial, particularly for beginners. A confusing or overly complex platform can make it difficult to execute trades and monitor your investments effectively. Additionally, reliable customer support is essential. Look for a brokerage with a responsive team that can assist you with any technical issues or questions you may have during your investment journey. Security is another non-negotiable aspect. Ensure the brokerage is registered with reputable financial authorities. This ensures that the firm complies with regulatory standards and protects your investments. Taking the time to carefully choose a trustworthy and well-suited brokerage can make all the difference in your investing experience, providing you with the tools and confidence to grow your wealth. 5. Know your investor profile. Understanding your investor profile is a foundational step to creating a portfolio that aligns with your financial goals, emotional resilience, and risk tolerance. Every individual has a different level of comfort when it comes to taking risks, and your profile determines the types of assets you should prioritize. Your risk tolerance falls into one of three main categories. A conservative investor prioritizes stability and low risk. This type of investor often feels uncomfortable with market fluctuations and prefers secure assets such as government bonds, savings accounts, or low-risk funds. While these investments may yield smaller returns, they offer peace of mind and capital preservation. A moderate investor is open to taking calculated risks in pursuit of slightly higher returns. This investor balances the portfolio with a mix of safer investments, such as fixed income products, alongside some riskier assets, like stocks or real estate funds. They understand the importance of diversification and are willing to accept mild volatility for potential growth. An aggressive investor, on the other hand, embraces high risk in exchange for the opportunity to achieve substantial returns. This profile is suited for individuals who are comfortable with significant market fluctuations and can tolerate short-term losses. They are likely to invest heavily in high-growth stocks, emerging markets, or other volatile assets that offer the possibility of greater long-term gains. To determine your risk tolerance, most brokerage platforms provide a questionnaire that assesses your financial goals, investment experience, and emotional reaction to market changes. By answering these questions honestly, you can identify whether you're conservative, moderate, or aggressive. Knowing your investor profile is essential because it helps you select investments that match your comfort level, ensuring you remain committed to your strategy during market highs and lows. 6. Start with the basics. Before diving into the stock market, it's essential to lay a solid foundation of financial knowledge. Investing is not about luck. It's about making informed decisions based on research, data, and understanding. The first step is to educate yourself on how the stock market operates, key financial terms, and the factors that influence a company's performance. A great way to start is by reading classic investment books. For example, The Intelligent Investor by Benjamin Graham provides timeless principles for value investing and understanding the risks and rewards of the stock market. In addition, staying updated on the latest financial news is crucial. Read market updates, company earnings reports, and sector analyses to gain insights into economic trends and potential investment opportunities. Company analysis is another critical skill for any aspiring investor. When evaluating a stock, start by examining its profitability. Does the company consistently generate profits, or is it struggling with losses? A profitable company is generally more stable and less risky. Next, look at dividends. If the company pays them, how much and how consistently. Dividends can provide a steady income stream, which is particularly attractive for long-term investors. Assess the company's growth potential by analyzing its revenue and profit trends over recent years. Finally, don't overlook debt. Companies with high levels of debt may face financial strain during economic downturns, reducing their ability to grow or pay dividends. By mastering these basics, you'll build the confidence and competence needed to make thoughtful investment decisions. 7. Invest in companies you know. As a beginner, it's wise to start by investing in companies you're already familiar with. This approach has two main advantages. First, you're more likely to understand the business model of a company whose products or services you already use. For instance, if you're a frequent user of a certain technology brand, you likely have some insight into its popularity, innovation, and customer satisfaction. This understanding can give you an edge in assessing the company's potential for growth and profitability. Second, familiar companies often operate in industries you already follow, making it easier to stay informed about relevant market trends and events. For example, if you regularly shop at a particular retailer or use a specific bank's services, you're likely aware of their customer experience, marketing strategies, and competitive positioning. A good strategy for beginners is to focus on market leaders in stable industries like technology, energy, consumer goods, or banking. These companies often have a strong market presence, reliable financial performance, and lower risk compared to smaller, less established businesses. While no investment is entirely risk-free, starting with recognizable and well-regarded companies helps you build confidence as you learn the intricacies of investing. By choosing businesses you understand, you not only reduce the intimidation factor of investing, but also set yourself up for a smoother transition into the world of stocks. Over time, as your knowledge grows, you can expand into more diverse and complex investments. 8. Diversify your portfolio. Diversification is a cornerstone of successful investing, aimed at reducing risk and increasing the resilience of your portfolio. It involves spreading your investments across various asset classes, sectors, and even geographical regions to avoid over-reliance on any single investment. By diversifying, you reduce the likelihood that a poor performance in one area will severely impact your overall returns. For instance, if you invest all your money in a single company and that company underperforms or goes bankrupt, you could lose a substantial portion of your wealth. However, by distributing your investments across different companies and sectors, you cushion yourself against such risks. In the context of stocks, diversification means investing in multiple industries, such as technology, healthcare, energy, and consumer goods, and balancing your portfolio between large, stable corporations and smaller, high-growth companies. For example, you might allocate a portion of your funds to established blue-chip companies like Itaú or Petrobras, which are known for their stability and consistent performance. At the same time, you can dedicate a smaller portion to emerging tech startups or companies in innovative sectors that, while riskier, have the potential for significant returns. Geographical diversification is another layer to consider. By investing in companies across different countries, you shield your portfolio from risks tied to a single nation's economy or political environment. Diversification requires thoughtful planning, but it's a crucial step in building a well-balanced portfolio that aligns with your financial goals and risk tolerance. 9. Start with small amounts. A common misconception about investing in stocks is that you need a lot of money to begin. In reality, modern investment platforms make it possible to start with modest amounts, allowing beginners to gain experience without taking on significant financial risk. For example, you can start investing with as little as $100, either by purchasing individual stocks or through ETFs, exchange-traded funds. ETFs are particularly beginner-friendly as they provide exposure to a diversified basket of stocks in a single investment, spreading risk even if you're only investing a small amount. Fractional shares are another excellent option for those with limited budgets. If the stock of a high-profile company like Apple or Amazon is too expensive, many brokerages now allow you to buy a fraction of a share. This means you can still own a piece of these companies and benefit from their growth, even if you can't afford a full share. Starting small also helps you build confidence and develop good investment habits without putting your financial stability at risk. Over time, as your knowledge and financial resources grow, you can gradually increase the size and scope of your investments. 10. Have a strategy. A well-defined strategy is essential for navigating the complexities of the stock market. For beginners, one of the simplest and most effective strategies is buy and hold, where you purchase stocks and hold onto them for an extended period, often years or even decades. This long-term approach allows you to benefit from the power of compounding and ride out short-term market volatility. It's particularly suited to those with limited time or experience, as it requires less active management. Another popular strategy is dividend investing, which focuses on building a portfolio of companies that regularly pay dividends. This approach creates a passive income stream, making it an attractive option for those seeking steady returns over time. By reinvesting your dividends, you can further accelerate the growth of your portfolio. For those interested in shorter time frames, trading involves actively buying and selling stocks to profit from price fluctuations. However, trading requires significant time, knowledge, and a higher tolerance for risk, as markets can be unpredictable. While potentially lucrative, it's not typically recommended for beginners until they've developed a strong understanding of the market. Ultimately, your choice of strategy should align with your financial goals, time commitment, and risk tolerance. Having a clear plan helps you avoid impulsive decisions and keeps you focused on achieving your objectives. 11. Track your investments, but don't overdo it. Once you've built your portfolio, it's important to monitor your investments regularly to ensure they align with your financial goals. This means staying informed about the performance of the companies you've invested in, as well as any news or developments that might impact their value. However, it's equally important to avoid over-monitoring your portfolio, especially if your strategy is long-term. Constantly checking stock prices can lead to emotional decision-making, such as selling during market downturns out of fear. Instead, establish a routine for reviewing your portfolio, perhaps quarterly or semi-annually. During these reviews, assess whether your investments are performing as expected and whether any adjustments are needed based on your goals or changes in the market. Maintaining a balance between staying informed and staying calm is key to becoming a successful investor. 12. Be prepared for market fluctuations. The stock market is inherently volatile, with prices fluctuating daily based on factors such as economic data, political events, and company performance. For beginners, these fluctuations can be unsettling, especially during market downturns when stock values may decline significantly. However, it's crucial to understand that such movements are a normal part of investing. If you've developed a solid investment strategy and chosen companies with strong fundamentals, there's no need to panic during temporary market declines. Long-term investors often benefit from staying the course, as markets historically recover over time. For example, during major economic crises, such as the 2008 financial crash, investors who held onto their investments ultimately saw substantial gains as markets rebounded. Emotional discipline is critical in these situations. Avoid making impulsive decisions based on short-term events and focus on your long-term objectives. By maintaining confidence in your strategy and being prepared for ups and downs, you'll develop the resilience needed to succeed in the stock market. Investing in stocks is a journey that requires patience, discipline, and continuous learning. Start small, educate yourself, and focus on building a diversified portfolio that aligns with your goals and risk tolerance. Over time, you'll gain the knowledge and experience needed to make more confident decisions and achieve your financial aspirations. Remember, the key to successful investing is consistency and a long-term perspective. If you ever have specific questions or need detailed guidance, don't hesitate to seek help. Every great investor started as a beginner.